the mid-caps that we're now going to focus on are from the QSR, the quick service restaurant space. Actually, a lot of these stocks are up and about today. Jubilant is up about 2%. Sapphire Food has some green on it. Devyani International, your Burger King, Restaurant Brands Asia, 1% up there as well. So largely green today, but that's not the story. The story is that these QSR stocks have actually underperformed the huge mid-cap rally that we've had. We all know that the mid-cap index is up about 24-25% for the year gone by. These stocks, most of them are up between 5% to about 14-15%. And one of them, which is Jubilant FoodWorks, so that's actually underperformed. Let's pull up the one-year charts to sort of talk about what I'm saying. Mid-cap index, remember, is up about 25% in the last 1 year. But a lot of these stocks, that's Jubilant. Jubilant, that's last 12 months, actually underperformed by quite a stretch. Even if you look at just this year's performance year to date, Jubilant has been an underperformer. The others are better off. The best performer is actually Westlife. Yeah, that's the one. Look at that. 12 months, 43%. So Westlife has been the king, really, when it comes to QSR. So what is the outlook ahead? For that, we have Kunal Vora joining in. He's from BNP Paribas. Kunal, welcome to the show. Thanks for being with us. So you are already cautious on the sector, and you don't seem to be sharing the optimism of some of your other peers from the analyst fraternity. Tell us why, and what is the concern, and why the underperformance on say, a stock like Jubilant? Is it just that pizzas are out of fashion, and after COVID, people are preferring to go out and dine?
Yeah, thanks for having me, Surabhi. So, yeah, we've been cautious on the space for a few quarters now. And the reason has been both on revenue front as well as on margin front. There has been a disappointment. So if you look at the revenue trajectory for these companies, it's been slowing down every quarter over the last few quarters. That's because of a combination of both same-store sales growth, which is slowing down, along with even the pace of store addition. So if I look at last 2-3 years, this industry's growth has really been driven by store additions. And the average daily store sales have not really been increasing. But now even the pace of store additions has been declining. A combination of these two factors is resulting in this industry seeing a meaningful slowdown in revenue growth. So that's one of the concerns. On the other hand, you also seen concerns on the margins. So if you look at the margin trajectory for these companies, if I look at the adjusted margins, which excludes rent, so the margins have gone down from 17-18% all the way down to 12-13%. And that's because of a combination of rising costs. They're adding new stores, they are seeing higher employee cost, operating cost is increasing. And at the same time, the same-store sales growth has been weak. Combination of these factors has resulted in sharp earnings cuts in the sector. So if I look at within the last 6 months, we've seen anywhere between 15 to 25% cuts in earnings estimates. Even this quarter, we saw another 4 to 8% cut in earnings estimates. So all of these factors are keeping us cautious and yeah.
A 15 to 20% cut in earnings since the beginning of the year, and post Q1, it's been about 4 to 8% of earnings cut. That's quite a bit, Kunal. Wanted to touch upon one particular aspect, the rising competition from the unorganized players. You're saying that's also hurting, and the organized players do not have pricing power or limited pricing power. Could you elaborate a little bit more on what your ground checks are suggesting on this rising competition from the unorganized players?
So we've seen that over the last few quarters, the organized players' growth rates, especially in the categories in which there is a lot of unorganized competition, especially in categories like pizza, we've seen the growth rate meaningfully slow down. Same-store sales growth has been weak, and revenue growth also has not really been coming through. Store additions for these companies also are starting to moderate. So competition seems to be hurting, especially during the pandemic. We had a period in which the large organized players were doing extremely well. And after the pandemic, we seem to have seen the unorganized competition making a fairly strong comeback. And that's a factor which is impacting the performance of some of the large pizza chains.
Okay, got that. Kunal, thanks a lot for joining us. Another space I want to talk to you about is the fact that in spite of all of these demand challenges that we are seeing, the Capex guidance for most of these players has been maintained, right, in Q1. Do you think we're going to see some scaling back of this? Do you think there'll be a cut to the, to the Capex plan now that demand is being hit a bit?
We do see a risk to the Capex guidance, despite very weak Capex, store additions in 1Q FY24. Companies have maintained their full year guidance. They have maintained their optimism for the full year, but we don't really share that optimism. We believe that you're currently getting into a situation where the EBITDA margin is going down, and the Capex is elevated, which results in very weak free cash flow generation, and that we don't see as a sustainable situation. Unless we see a strong recovery in volumes, we believe that the Capex guidance might need to be cut down.
Okay. So Kunal, you do sound very, very cautious on it. But, let me play the devil's advocate here. Could this be a pass-through phase? You kind of look through some of these trends because immediately after the COVID reopening, obviously everybody wanted to do anything but keep ordering from the same QSRs. So, at a sustainable, normalized rate, and I'm talking for people who want to be in this segment for the slight sort of medium to longer term, then what should they be looking at? Look at a company like Westlife, for instance. Clearly, they're doing something different, and that's showing up in the stock price. So in terms of stocks as well, tell us whether you're negative on all or whether you have a buy on any one of them.
Sure. So if you look at what kind of optimism is already getting built in for most QSR companies, FY24 to 26, the expectations are that they will grow between 15 and 20% on revenue terms. On EBITDA terms, the expectation is as high as 20 to 30%. So that's a kind of optimism which is already built into the stocks. And on these earnings estimates, the stocks are trading anywhere between 50 and 70 times. So we see high level of growth expectations along with high valuation multiples. And that's something which we believe could result in a period in which the stocks can see time correction. In terms of our coverage, we don't cover all of these names, but we believe that this sector could see time correction. And that's because of the elevated valuation multiples along with high expectations.
Kunal, just about the near term, and there was this article in the Pink Papers exactly 2 days back. Mall sales perk up amid rise in footfalls to movie theatres. So if movies are selling like hotcakes, people are flocking to the malls. There are all these QSR chains in the malls, and then there would be increased footfall in them as well. So just about Q2, can you tell us what have you picked up?
So Q2, we expect to be another weak quarter for this industry. Like while mall footfalls might have gone up, it's a very small proportion of revenue for the large QSR chains. That's not really a factor which will help much. What will happen is the recovery will be gradual. It's not that in a quarter's time, after a week 1Q, things are going to change dramatically. We might watch out, we'll watch out for second half of FY24, in which there could be a recovery, but in 2Q itself, what will also play a role will be various Hindu festivals, which typically result in some weakness in sales of the QSR chains.
Okay, Kunal, just finally, before we let you go, if you can take us through your recommendation on all of these stocks, what is the kind of rating you have?
So we have a cautious view on the sector. We cover only one stock, and on that we have a hold rating with expectation of a decline over the next 1 year in terms of stock price performance.
Okay, Kunal, we'll leave the conversation here. Thank you very much for joining in. Look forward to another chat with you on different sectors as well. Get into a break on